Raj, on your perspective, you're enabling banks to make this difference related to the innovation. Maybe you can also say a word about Galitics and how you are actually enabling banks to create value.
Sure. Hello, everyone. So Galitics is started about 7.5 years ago. What we've done is built a smart data analytics platform that ultimately, as Henrik was describing, reimagines the data analytics world by creating a fully connected data ecosystem, enabling banks and insurers to really connect the dots between their operational, transaction, and alternative data. One of the examples that I would use in terms of how we are delivering impact is, if you look at banking world across private, corporate, and SME lending, it typically takes about 3 to 5 weeks for a decision to happen on a credit application. Through Galitics platform, you're able to really turn that into 24 hours to 3 days maximum, depending on standardized or non-standardized deal. That's a significant shift. And how we are able to do that is, number one, we are able to bring together, as I said, operational, financial, transactional, and alternative data and create synthetic financial statements out of that data and then drive that process forward all the way to a credit decision. Now, when we talk to banks, specifically the number one criteria is, the front office doesn't talk to the credit teams. There's always friction. Number two is algorithms are like, we don't trust the outcome. So in order to address those two problems, we have human in the loop. So it's not just all black box algorithms. There is a human in the loop to make decisions happen. And number two is, when we digitize the whole credit process, it's done on a case-by-case basis, i.e. you can see the whole throughput front to back in driving a credit decision. That's the way we are delivering impact at banks at the moment.
That's great. Sounds very exciting. Maybe, Raj, on your side, when we talk about, let's say, collaboration with fintechs, it always comes to the bottom line and the financial results. So my question would be, how do you measure the financial results that you can bring to the banks?
So typically, when we deploy our platform, if you take a typical bank with a 250 billion balance sheet, our platform ultimately has the ability to deliver about 230 million in annual profits, which is a substantial number. Now, let me sort of break that number down. Ultimately, there are 3 levers of return on investment that we see in deploying our platform. Number one is, how do we improve the time to decision, i.e. how does that deliver higher revenues? So we see typically between 15 to 20% increased revenues. Number two is the reduction in credit losses. So typically by, again, deploying a connected data ecosystem, we see on average between 20 to 40% reduction in credit losses. And finally, the operational efficiency. And by that, I don't mean like banks reducing credit analysts. I mean, given the environment we are in right now, the regulatory pressure plus the ESG, it's creating a lot of imbalance in credit analysts' ability to provide do their jobs effectively in line with the relationship managers. So we see operational efficiency gains between 15 to 20%. So in summary, the ROI case is very strong. Obviously, when banks have embarked on this digitization journeys, they've taken on this whole big bang approach, and 8 out of 10 banks we have seen to have failed because they start with this mega 5-year journey and it hasn't really achieved its goal, or the excitement runs out in the first 12 months, and then you find, you're basically trying to just back solve, how do I now make it work? We take a different approach on that front.
Okay, thank you.